What are stocks? What are bonds? Are those different from mutual funds and ETFs? And why do people always talk about risk? What is that? We'll talk about all of that right now. When you're investing in the market, you might hear about things like stocks, bonds, cash, mutual funds. What are those? So let's get started. What is a stock? A stock is buying a tiny piece of a company. You like Google, you like Apple, you can be an owner of the company. Buy one stock, you are now an owner. There are different types of stocks. There are large cap, small cap, mid cap. There's domestic, there's international, emerging, global. What do these all mean? So a large cap stock is an example of a US company that is gigantic. So again, they're not paying me, but I'm going to mention Google and Apple again. Those are giant companies that have a worldwide footprint. An example of a mid-cap company could be a company that's pretty big in the US, maybe not as much overseas. So companies that you may have heard of that are mid-cap are things like Duolingo, the foreign language app on your phone, or Crocs, your kid's favorite ugly shoe. Small cap stocks are small up-and-coming companies in the US that are wanting to eventually be a mid-cap or a large cap, but right now they are small. International companies are kind of like large caps in the US, but overseas. So an example of that would be Toyota or Nestle. Those are big, big companies based outside of the US that have a global footprint, as well as a footprint here in the US. Emerging markets are also international companies outside of the US, but they tend to be from countries that have more political or economic turmoil. So examples of that are countries in South America and Southeast Asia. Global stocks are exactly what you think they are. They're a mix of everything. They can have US stocks and international stocks, and they combine them all together. You may have also heard of sectors. So sectors are potentially a collection of stocks that have a theme to them. So healthcare, for example, if you buy a healthcare mutual fund or ETF, which I'll define that in a second, that could be just a collection of healthcare related stocks. A bond, instead of owning a piece of something, you are actually loaning your money to a government or a corporation. Those are the two basic types of bonds, actually, corporate and government. You are loaning money to your city, state, or the country to help build a bridge, a toll booth, or just fund the overall debt. On the other hand, a corporation, perhaps there's a corporation that needs to extend and create a new factory or hire more people overseas. You're loaning them money to get that done for a certain period of time. Bonds have a maturity date, just like a mortgage. So for example, a mortgage could have a 30-year maturity date. Bonds could have a short, medium, or long-term maturity date. Your friend with a bad credit card debt pays a higher interest rate to that credit card because maybe they're a little less trustworthy. They don't pay their stuff on time all the time. A high-yield bond is kind of the same way because maybe they might not pay you on time. Most of the time they will, but you are taking that little chance that they could stumble and not pay you back at all or not pay you back in time. So they're going to entice you with the higher interest rate to have you loan them your money for a period of time. On the opposite end of the spectrum, instead of high yield, there is high rated. So there are solid cities or states that basically never default or has very little chance of not paying you back. Those are very high rated, trustworthy places to loan your money. And because they're high rated and they're kind of boring, they don't need to pay you a lot of interest because you know you're going to get it back. You're not really taking a chance. It's pretty low risk. So high rated, maybe a lower interest rate. High yield, higher interest rate, a little more risk there. So I just touched upon a little bit on risk for bonds. So risk for stocks, I'm going to compare it to people. Okay, so a large cap stock tends to be less risky overall than, let's say, a small cap stock. So think of the largest person you know and try to give them a shove. It's harder to make them move. And then think of the smallest person you know, maybe a kid. If you shove them with your finger, they might fall over. So stocks are kind of the same way. Think of volatility as an up and down movement of the price. Large cap stocks don't really bounce up and down that much, whereas small cap stocks can. Any little bit of news of a small cap stock, like a bad piece of news, can make them tank. Whereas with a large cap stock, some bad news, it might go down a little bit, but definitely is not as reactive. So that is kind of the way risk works. It's inertia, right? Large moves less, small moves a lot more. Another way to think about risk is maybe combining different risk levels, right? So I know a ton of people that are like, I'm just going to invest in the S&P 500 and I'll be fine. Maybe. But every once in a while, the US stumbles. And then what are you going to do? Your whole S&P portfolio is going to fall. Now, if you mix the S&P 500 with some international, and then you put them together in a portfolio, you combine different types of risk to lower your overall risk. Because sometimes countries outside of the US do well when we don't, and vice versa. So that's why you want to mix things together. Speaking of mixing, what's a mutual fund and what's an ETF? Mutual funds and ETFs are mixes of stuff, right? So instead of buying 5 stocks, a mutual fund or an ETF could have 500 stocks inside of one mutual fund. Now, mutual funds and ETFs tend to have something called an expense ratio. It's a little bit more expensive, let's say, than if you just bought 500 stocks of your own. If you could afford to do that, I can't. But think of a mutual fund or an ETF as like going out to eat or buying a pie that's already made. You're paying for the labor of having it pre-packaged for you so that you can just buy it really easily. I don't mind it, because there is diversification there, and it does tend to lower your risk if you can mix the pieces well. All right, why investment management? Why hire a financial planner or a financial advisor to help you do this? You could do this yourself. Well, you could, but portfolios are not a one-size-fits-all. There are delicate ways of mixing and matching and changing your risk level so it's appropriate to you, and even actually measuring your risk level and what your needs are for now and in the future. So an investment manager can help you with all of these. Plus, research has shown that individuals, we're just emotional beings. So time and time again, tons of psychological research out there that individuals, when left to their own devices, will buy high when prices are sky high, and they'll sell at the lowest of lows, which is really detrimental in the long term to your financial health and to the growth of your money for the long term. So a financial planner or financial advisor can help you with that by making more logical decisions and keeping the distance of your portfolio away from your emotions to the extent that it's possible, so that they can help you buy low and sell high. All right, so we just went through the ABCs of different types of investments and risk and investment management, but I want to remind you, investments and investment management, there is no one-size-fits-all approach. It's totally custom to you. Everyone's different with their needs and wishes. If you want to chat more about this, feel free to reach out to me directly through thewealthgardenfs.com, where we do provide financial advice to our clients. We also have our blogs, videos, articles, our podcasts there. Otherwise, if you like what you saw here, check out our other ABC videos and subscribe to our YouTube channel.